Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Tuesday, November 18th, 2025, and we're here to break down the market buzz from yesterday's data, November 17th.
That's right, Ethan. We had a pretty active day on the social media front, with a significant number of posts flagging several different stocks for our attention. Overall, the sentiment out there is a real mixed bag today, a bit risky in some corners, but also some promising growth signals coming through.
Absolutely. Our AI-generated insights have really dug deep, so let's get right into it and see what opportunities and pitfalls our community is highlighting. First up, we're talking about Alphabet. That's GOOG. You know, the social media buzz around GOOG is overwhelmingly bullish. Users are highlighting its strong AI infrastructure and the anticipation around products like Gemini 3. One poster even mentioned realizing significant gains from selling calls and holding shares long-term, looking to buy even more. This isn't new for GOOG. We've rated it a buy consistently, and it seems that sentiment is holding strong, especially with news like Berkshire Hathaway taking a big stake and Alphabet's $40 billion investment in AI infrastructure. That just screams future growth to me.
Hold on a minute, Ethan. While the user sentiment and those growth points are compelling, and yes, Goog has delivered strong revenue growth at 15.9% and an impressive net profit margin of over 32%, we still need to look at the full picture. The stock is trading near its 52-week high, and its PE ratio of 28.16 suggests a lot of future growth is already priced in. What concerns me, however, is the high debt-to-equity ratio of 11.424. For a tech giant like Alphabet, that's a red flag that warrants a closer look, even with their substantial cash flows. It's certainly a point of financial risk to be aware of.
That's a fair point, Brooke, but given the sheer scale of their AI investments and the overwhelming market confidence reflected in that robust revenue growth and profit margin, it seems the market is viewing that debt as manageable for future expansion. So, all things considered, for GOOG, we're going to reaffirm our buy classification. The potential for continued growth in AI seems to outweigh that debt concern for many. Moving on, let's talk about Cheniere Energy, ticker LNG. This one has seen a fresh wave of interest in our hot leads. The social media discussion really praises LNG as a blue-chip success story, having transformed from a heavily indebted company into a $45 billion powerhouse today. They're cited for securing long-term contracts and effectively managing their debt, which is a big feat in the energy sector. Plus, with news about increasing global demand for LNG, especially from places like Ukraine and overall U.S. natural gas consumption exploding, the future looks bright.
It certainly sounds like a turnaround success, Ethan, and the KPIs largely support that narrative. A market cap of over $47 billion confirms its size, and a 12.06 PE ratio is quite reasonable. Revenue growth is a solid 19.1%, and an astounding return on equity of nearly 50% really shows efficient management. Now, while the debt-to-equity ratio is still high at 228.113, the context suggests it's a characteristic of the sector, and they've reportedly proven capable of managing it. Their low beta of 0.256 also points to surprising stability for a company in this sector.
Exactly. That low beta is a big deal for stability. So when we factor in the proven track record, the strategic long-term contracts, and the favorable global demand, it really positions Cheniere Energy as a strong player. We previously rated LNG as a buy, and given this data, we are going to continue that today. Our final verdict for LNG is buy. Okay, let's switch gears to Robinhood markets, Hood. We've seen a slight uptick in discussions here. What's interesting is that despite one user trying to short Hood, the overwhelming sentiment from the community is actually quite bullish. People are saying Hood is winning in this market, with some even targeting 150, which is getting close to its 52-week high. You know, with revenue growth at a staggering 100% and a net profit margin over 52%, it's hard not to feel optimistic. News about Bridgewater betting big on Robinhood definitely adds fuel to that fire.
That revenue growth is undeniable, Ethan, and the profit margin is excellent. However, we've got to acknowledge that high PE ratio of 48.32, indicating very high expectations for future performance. And while their market success is evident, we can't overlook the debt-to-equity ratio of 188.794. That's a significant amount of leverage for a company, even a high-growth one, and it flags as a considerable risk in my book. We've had Hood as a speculative gamble recently, and while the growth is real, that debt is a definite concern.
I hear you on the debt, Brooke, but the growth figures are just too strong to ignore. While the risk is there, Robinhood clearly demonstrates strong operational performance and market traction. Given the massive revenue growth and clear profitability, this feels like a positive shift. So we're going to upgrade Hood from a speculative gamble. Our verdict for Hood today is a cautious buy. It shows massive potential, but that debt needs to be monitored. Finally, let's tackle New Fortress Energy, NFE. There's been a consistent but low level of chatter. Users are definitely trying to make a bullish case, pointing to classic short squeeze indicators like high short interest, huge borrow fees, and a low float. There's talk of significant future contracts in Puerto Rico and Brazil, and some analysts see it as heavily undervalued. The community is hoping something is going to happen.
Well, something is going to happen, all right, Ethan, but it might not be what the optimistic users are hoping for, Ethan. The KPIs for NFE paint a dire picture. We're looking at deeply negative revenue growth, a net profit margin of almost negative 50%, and substantial negative earnings per share. The stock is trading near its 52-week low after a massive decline. And the debt to equity, an astonishing 675.114. This isn't just high leverage, it's extreme financial distress. Recent news reports even state that NFE is considering UK debt restructuring to avoid bankruptcy.
Wow, to avoid bankruptcy is a phrase no investor wants to hear. So, despite the speculative short squeeze potential that the social media discussions are hinting at, the fundamental financial health is clearly screaming warning signs.
Exactly. While there might be a short-term technical play for some extremely high-risk traders, for any investor looking at underlying value and stability, NFE is a very risky proposition. We've classified NFE as stay away before, and the current data only reinforces that. The potential for new contracts is dwarfed by the current severe operational losses and massive debt load. My verdict for NFE is unequivocally stay away.
All right, let's wrap up today's hunt with a quick overview of our top candidates for deeper analysis. Investigate as buy, Alphabet Inc., GOOG, Cheniere Energy, LNG. Investigate as cautious buy, Robinhood Markets, Hood. Investigate as speculative gamble, New Fortress Energy, NFE.
And that brings us to the end of today's episode.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for joining us on the Daily Hunt for Multi-Baggers. We'll catch you next time.